The US economy is approaching a shift that most people won't see until it's too late, and I'm not talking about a recession, I'm not talking about a market correction, I'm talking about something structural, a fundamental change in how the entire system operates. The data is now screaming something that the mainstream narrative is desperately trying to ignore. I'm Raoul Pal. I spent 20 years at Goldman Sachs and GLG Partners watching these structural shifts develop before they hit the headlines. I retired at 36 because I learned to read these signals early. And right now? The signals are as clear as anything I've seen in my career. Here's the number that stopped me cold. The United States government is now spending $970 billion per year, nearly $1 trillion just on interest payments. Not on defense, not on healthcare, not on infrastructure, just the interest on money already borrowed. In 2020, that same number was $345 billion. The interest bill has nearly tripled in 5 years. That's not a policy choice. That's not something they can vote to fix. That's arithmetic taking control of the system. Subscribe to this channel. The people who understand what this means are positioning very differently than those who don't. Part 1. The Everything Code and the Debt Trap. Let me connect this to my Everything Code framework. Global liquidity is the master variable that drives all asset prices, but there's a corollary most people miss. When debt service costs consume an increasing share of government spending, the only mathematical escape is more liquidity creation, which means more currency debasement. Here's the trap: $38.5 trillion in total US national debt. $10 trillion in Treasury debt maturing in 2026 alone that must be refinanced at much higher rates, $1+ trillion in annual interest payments, and climbing $2 trillion annual deficit adding to the pile. The Fed is arithmetically trapped. They can't raise rates aggressively without triggering a debt service crisis. They can't cut rates aggressively without reigniting inflation. They can't stop the spending without collapsing the economy. There is only one way out: print more money, expand the balance sheet, debase the currency. And when that happens, when the debasement accelerates, it changes everything about how you should be positioned. Part 2. The 11% hurdle rate reality. This connects directly to my 11% hurdle rate framework. Most people think if they earn 5% or 6% on their money, they're doing fine. They're not. Here's the math. 8% annual currency debasement, money supply expansion, diluting your purchasing power. 3% official inflation and real inflation is higher, equals 11% minimum return just to maintain purchasing power. You're not trying to get rich at 11%, you're trying to not get poorer. Now here's where the dangerous shift comes in. As debt service costs explode and the Fed is forced to expand liquidity to prevent a funding crisis, that 11% hurdle rate becomes the 15% hurdle rate, maybe the 20% hurdle rate. The treadmill is speeding up. Most people's savings sitting in bank accounts earning 4%. In bonds yielding 5%, in money market funds are losing purchasing power every single day. They think they're being conservative, they're actually being eroded. This is the shift that's dangerous, not because it's dramatic, because it's invisible. It happens slowly, quietly, systematically, while people watch their account balances and think they're fine. Part 3. The smart money sees. Let me show you what the institutional money is actually doing, because their actions tell you everything the news won't. Central banks around the world bought 863 tons of gold in 2025. They've been accumulating for years. They bought gold for 15 consecutive months at one point. They're not doing this because they think the dollar will be fine. They're doing this because they understand what happens when a monetary system reaches this kind of stress. China has moved more than $1.2 trillion out of US Treasury holdings over the past decade. Their Treasury market share has fallen to 7.3%, the lowest since 2001. They're not making a dramatic exit. They're making a methodical, deliberate repositioning into gold and non-dollar assets, institutions. The smart money doesn't announce on Twitter what they're buying. They don't post TikToks. They don't make thumbnails with their mouths open. They buy quietly and consistently. And by the time you see them on TV talking about it, they're often doing what Wall Street calls selling their book, talking up what they already own, so someone else pays a higher price later. The pattern is clear. The people who understand the debt dynamics are exiting paper promises and entering hard assets. Part 4. The dangerous shift explained. Let me be precise about what this dangerous shift actually is. It's not a crash. Crashes are dramatic, obvious, and temporary. This is a regime change, a fundamental restructuring of how the monetary system operates. Here's what's shifting. Shift number 1, from wealth creation to wealth preservation. For 40 years, falling interest rates created a tailwind for asset prices. Bonds went up. Stocks went up. Real estate went up. You could buy almost anything and win. That era is over. We're now in an era where the primary challenge isn't growing wealth, it's not losing it to debasement. The rules have changed, but most people are still playing the old game. Shift number 2, from paper to hard assets. When confidence in the monetary system cracks, capital flows out of paper promises and into assets that can't be printed. Gold, 5000-year store of value, now being accumulated by central banks. Bitcoin, digital hard asset with mathematical scarcity, only 21 million will ever exist. Productive real assets, land, infrastructure, businesses with pricing power. The shift isn't coming, it's already happening. Gold crossed $5,000, Bitcoin recovered from its lows, central banks are buying, institutions are repositioning. Shift number 3. From dollar dominance to multipolar competition. The dollar's share of global foreign exchange reserves has been declining for years. China, Russia, and emerging markets are building alternative settlement systems. This doesn't mean the dollar dies tomorrow. It means the premium the US has enjoyed for decades, the ability to borrow cheaply because everyone needs dollars, is eroding, and as that premium erodes, the math gets worse. Higher borrowing costs, more interest payments, more pressure to print, more debasement. It's a self-reinforcing cycle. Part 5. The 3 scenarios. Let me walk you through the 3 most likely paths from here. What I want you to see is that all 3 scenarios lead to the same investment conclusion. Scenario 1. Managed soft landing. The Fed threads the needle perfectly. Inflation cools. Growth continues. Debt is gradually addressed through economic expansion. Probability. This is the consensus hope. History suggests it's the least likely outcome when debt to GDP is this high. Even in this best case, currency debasement continues at 6-8 annually. Hard assets outperform cash and bonds over time. The 11% hurdle rate remains in effect. Result: gold performs, Bitcoin performs, quality equities with pricing power perform. Scenario 2. Inflationary spiral. Energy shocks, geopolitical disruption, or fiscal expansion triggers a second wave of inflation. The Fed is forced to choose between crushing the economy or letting inflation run. Probability: moderate and rising. Especially with geopolitical tensions escalating, in this scenario, the 11% hurdle rate becomes 15-20. Cash and bonds are destroyed, hard assets surge. Result: gold performs, Bitcoin performs, commodities perform. Scenario 3. Deflationary shock, then massive response. A credit event, perhaps in private credit, commercial real estate, or sovereign debt, triggers a deflationary crash. The Fed responds with the largest liquidity injection in history. Probability: this is the break something, then print scenario we've seen repeatedly. In this scenario, initial crash in all assets, followed by explosive rally in hard assets as liquidity floods the system. Result: after the shock, gold performs, Bitcoin performs, quality assets bought at crisis lows perform dramatically. The answer is the same regardless of which path we take. The assets that win are the ones that can't be printed, can't be debased, and maintain value when confidence in paper promises erodes. Part 6. The DTFU framework. Here's how to navigate this dangerous shift. DTFU: don't F this up. Step 1. Calculate your real exposure. Most people have no idea how concentrated they are in dollar-denominated paper assets. Go through everything: bank accounts, money market funds, bond portfolios, treasury holdings in retirement accounts. Add it up. Calculate the percentage of your net worth that depends on the continued purchasing power of the US dollar. Most people who do this honestly are shocked. They're 80%, 90%, sometimes 95% exposed to a single currency regime. You cannot change what you have not measured. Step 2. Build hard asset exposure. Start moving a meaningful portion toward assets that exist outside the paper system. Gold, physical or allocated. Not paper ETFs that give you a claim. Actual metal. Bitcoin, self-custody or quality institutional custody. Understand the keys. Quality equities, companies with pricing power that can pass inflation through to customers. Productive real assets, if accessible, land, infrastructure, essential businesses. The goal isn't to go all in on any single asset. The goal is to reduce concentration in a single failing system. Step 3. Understand the timeline. This shift doesn't happen overnight. It happens over years and decades, but the repricing of assets often happens in weeks and months. The people who position before the repricing capture the move. The people who wait for confirmation become the exit. Liquidity. The time to build the ark is before the flood, not during. Step 4. Watch the right signals. Stop watching the news. Start watching 10-year Treasury yield. If it breaks and holds above 5.5%, the bond market is pricing in structural stress. Fed balance sheet. Expansion means liquidity injection, which means debasement. Dollar index. Sustained weakness signals loss of reserve confidence. Gold and Bitcoin. Breakouts on volume mean institutional repositioning. The charts tell you what money is doing. The news tells you what someone wants you to think. Let me leave you with this. The dangerous shift isn't dramatic, it's invisible. It's the slow erosion of purchasing power while your account balance stays the same. It's the quiet repositioning of central banks while the news talks about something else. It's the gradual movement of capital from paper to hard assets while most people don't notice. The danger isn't a crash you can see, it's a theft you can't feel. $970 billion in interest payments tripled in 5 years, $38.5 trillion in debt with no path to reduction, $10 trillion maturing in 2026 that must be refinanced, central banks buying gold at record pace. China exiting treasuries systematically, the Fed trapped between inflation and debt crisis. The pattern is unmistakable, the math is undeniable, the shift is underway. The only question is whether you'll adjust your positioning before the repricing or after. The people who understand what's happening are building arcs. They're accumulating hard assets, they're reducing exposure to a system that's mathematically unsustainable. The people who don't understand will wake up one day and realize their safe savings by half of what they used to and wonder what happened. The magic is out there, but you have to see the shift to navigate it. Don't F this up.